So we have discussed the concept of the bond yield and the bond valuation. Now what we shall be doing is, we shall be attempting a few questions with respect to the bond yield and bond valuation. So the examiner has tested this area, bond yield and bond valuation, in the past in detail. So what we are going to do is that we are now going to attempt questions pertaining to it. So let's just come on to this question number 1, which is December 2007. December 2007, question number 1. The name of the question is your company. The name of the question is your company. The requirements of the questions are, it says advise on the coupon rate that should be applied to the new debt issue to ensure it is fully subscribed. Now I'm going to give you people a hint that what exactly do you mean by a coupon rate that would ensure full subscription. Now, if you are an investor, why would you invest in a bond? Because you would be getting a return which is equal to at least the market return. You would be getting a return which is equal to at least the market return. If you are getting return which is equal to at least the market return, then you would invest in a bond. Is that okay? Now, so you need to establish that what would be the rate at which the bond would be fully subscribed. It would be fully subscribed if we offer a rate which is at least equal to the market return. That's number 1. Now, what is number 2? It says estimate the current and revised market valuation of the company's debt and the increase in the company's effective cost of debt capital. Now, when it says estimate the current and revised valuation of company's debt, so you need to establish the current value of debt. You need to estimate the revised value of debt. And the third thing it says increase in the company's effective cost of debt capital. When we say effective cost of debt capital, that means we are talking about KD 1 minus T. When we talk about effective cost of debt capital, that means we are talking about KD 1 minus T. Is that okay? So that means you need to establish the difference between the KD 1 minus T before the change and KD 1 minus T after the change. So let's just try to attempt this question and we shall discuss in 5 minutes time. Okay, so let's actually start discussing about this question. It says your company, which is in the airline business, is considering raising new capital of $400 million. So what is it planning to raise? It's planning to raise $400 million in the bond market for the acquisition of new aircraft. So that's what we want to acquire, a new aircraft. It says the debt would have a term to maturity of 4 years. So what do we want to raise? We want to raise 400 million, 4-year loan. The market capitalization of the company's equity is 1.2 billion. That means the market value of equity is 1.2 billion. Furthermore, it says it has a 25% market gearing ratio. That is market value of debt to market value of equity of the company. Now, market value of the company. So basically what happens is, so the debt upon debt plus equity is 25%. Now, what else is it? It says this new issue would be ranked for payment in the event of default equally with the company's other long-term debt, and latest credit risk assessment places the company at AA. Interest would be paid to holders annually, so there is an annual interest payment. The current debt carries an average coupon of 4% and has a 3-year term to maturity. The company's effective rate of tax is 30%. So the company's effective rate of tax is 30%. It says the current yield curve suggests that at 3 years, government treasuries yield 3.5% and at 4 years, they yield 5.1%. It says the current risk spread is estimated at 50 basis points at AA. If the issue proceeds, the company's investment banker suggests that 90 basis point spread will need to be offered to guarantee the take-up of its institutional investor. Now let's talk about this. So if we discuss this whole, now what exactly are the things that need to be discussed about this? Basically, the first thing that we are being told is that the company has a gearing of 25%. So 25% is the gearing, and that means debt upon debt to equity is actually 25%. Debt upon debt to equity is 25%. We are actually being told that the company's equity has a market capitalization of 1,200 million. So this 1,200 million is actually equivalent to 75%. So how much is the debt, which is 25%? So you would say the existing debt, is going to be 1200 divided by 0.75 multiplied by 0.25. So it's 1200 divided by 0.75 multiplied by 0.25. How much does it turn out to be? 400 million. So as per the information, as per the current information, what we understand is that the company has 4%, $400 million bond with the average 3-year terms to maturity, 3-year debt. That's what the company has right now. Now the requirement of the question was, it says advise on the coupon rate that should be applied to the new debt to ensure that it is fully subscribed. Now let's just see. We are being told that the company's existing credit rating, is actually double A. We are being told that the company's existing credit rating is double A. And what else do we know about it? It says that the current yield curve suggests at 3 years the government treasuries yield 3.5, at 4 years they yield so and so. The current credit spread is 50 basis points at A. If the issue proceeds, the company's investment bankers suggest that a 90 basis point spread will need to be offered to guarantee its take-up by its institutional clients. Now let's see. First of all, assuming if I need to issue the bond at par value, so my coupon rate should be equal to the market rate. Is it understood? Okay. So what exactly is going to be the market rate? So the bonds that we are planning to issue are actually 4-year bond. The bonds that we are planning to issue is actually 4-year bond. Now, if this bond is actually a 4-year bond, so what exactly do we need to know? The market rate is going to be the 4-year government treasury is 5.1%. And it says that you will have to offer a 0.9% credit spread in order to take up the full take up of the bond by the institutional investor. That means 6%. So when the examiner asks us that what should be the coupon rate that should be applied to the new bond, so we need to give a detailed answer like this, that if you issue the bond at a par value, then the interest and the coupon rate should be 6%. If you issue the bond at premium, then it should be more than 6%. And if you issue the bond at a discount, then it should be less than 6%. Because ultimately we need to ensure that we end up giving a total overall return of 4% to the investors. Ultimately, we need to ensure that we end up giving a total return of 4% to the investor. Okay, so now let's just see. The new bond that we want to issue is going to be a 4-year term to maturity. So the government yield curve of 4-year term to maturity is 5.1%. And it says the appropriate credit spread is 0.9% for the 4-year term. So if the appropriate credit spread is 0.9% for the 4-year term, that means it is going to be 6%. So basically, if we issue the bond at par, then the rate is going to be 6%. If we issue the bond at premium, that means we are demanding more than $100 from the investor. Then he would say, I need a greater return because the market return is 6%. So I need a return that could actually end up compensating it to 6%. And if we issue the bond at discount, the investor would be agreeable to a lower coupon, because that would ensure, a lower coupon would ensure that the yield of 6% is achieved. Okay, is that fine? Okay, now let's actually move forward. Let's discuss. The second thing that we need to discuss about it is the second requirement of the question was, it says estimate the current and the revised market valuation of the company's debt and the increase in the company's effective cost of debt capital. Now you need to understand one thing. What exactly is the current debt? So the current debt has a value of 400 million. Current debt has a value of 400 million. We did calculate it just now. Now, what exactly is the revised market value of debt? So when we talk about the revised market value of a debt, there is new debt plus there is old debt. So the new debt would have a value of $400 million. You would say why? You would say why? Because we intend to raise additional $400 million. Obviously, we are going to be issuing it at a market rate. So that means if the coupon rate is equivalent to market rate, then the par value is equivalent to the market value. This is the concept that we discussed, that if the coupon rate is equivalent to market rate, the par value would be equivalent to market value. So we would have a market value of what? $400. Is that okay? Now what next? So the market value of the debt, we say that the new bond would have a market value of the debt of 400. The old bond, the market value of the old debt would now be changed. Why it is going to be changed now? Because the company's credit rating has changed. Originally, the government, you see, the risk-free rate for a 3-year yield curve is 3.5%. That's what's given in the question. Originally, we had a credit spread of 0.5. But now if we issue more bonds, the credit spread will enhance. So the credit spread will now become more than 0.5 and it would become 0.9. So basically what happens is, if we need to calculate the old debt's market value, how would we do it? We would say here, we would say cash flow, we would say discount factor, and then the present value. So year 1 till year 3 is basically 400 into 4%, because we are being told that the existing debt has an average coupon of 16, as the average coupon of 4%. And then in year 3, there is going to be a redemption of 4. But the discount rate now is going to be 4.4%. You would say, how did we get this 4.4? So it's 3.5% plus 0.9%, because your credit spread has changed because of the issuance of a new debt. So resultingly, it is going to be 3-year annuity factor at 4.4%, and it's going to be 1.044 power minus 3. So what is going to be the present value of this debt? Okay, so the entire value turns out to be 395.6. So what was the examiner asking us to calculate? He was asking us to calculate that what is going to be the value of the debt before and after the issuance of the new bond. So it was originally 400, now it's going to be 395.6, right? So it's now going to be 795.6. The original credit rating was had a credit spread of 0.5. But once we issued the new bond, so the credit rating deteriorated, and resultingly the relevant credit spread for our company is now 0.9%. Okay, so we have got the first thing that we have got is we have got 395.6 as the value of the old debt. So that means the value, existing value of debt was basically 400, and the revised value of the debt is 795.6. Now, there's another requirement to the question, which is it says the effective cost of debt capital. Effective cost of debt capital. Now, you need to understand that what is the cost of debt. So the cost of debt is basically the cost of debt is actually equivalent to the market interest rate. The cost of debt is not what we actually pay. Cost of debt is the market interest rate. Now, how do we get the relevant cost of debt? Let's just try to understand. How do we get the relevant cost of debt? Let's just try to understand. So if you want to establish the relevant cost of debt, you would establish it this way. You would actually say that the relevant cost of debt is going to be the existing cost of debt was basically 3.5% plus 0.5% gives us 4%. And it was actually the effective was 4 multiplied by 1 minus 0.3. So it was 2.8%. That was what the cost of debt was. Yes, after tax. Because when we say effective cost, that means after tax. Okay, now if we talk about the revised cost of debt, so what is gonna be the revised cost of debt? Let's talk. So basically now the credit spread has become 0.9%. So basically what happens is you would say 4.4% multiplied 395.6 divided by 795.6 plus 6% multiplied by 400 divided by 795.6. So it's 4.4% into 395.6 divided by 795.6 plus 6% into 400 divided by 795.6. What is it? We are calculating the weighted average cost of debt. Okay, so this 5.2% is the gross cost of debt. This is not effective. So what we need to do is that 5.2% multiply 1 minus 0.3. So 3.64% is going to be the effective cost of debt. 3.64 is going to be the effective cost of debt. You see, now we have got two debts. One of them is a 4-year debt and the other one of them is a 3-year debt. So basically the 3-year debt had a government bond of 3.5% plus 0.9%, which was the credit spread, so it became 4.4. And the 4-year debt has 5.1 plus 0.9, makes it 6%. That's how it will be. Okay, so that's what we have got. So what I would suggest you people to do is that I would suggest you people to attempt this specific question on your own at your places. Question number 3, December 2011, Levant Company. And then we could actually have a discussion about this question in our next class. So let's keep it till here. Thank you very much. Let's meet up in the next class now.